How much longer can big tech lead the way without participation from the other sectors? First up, let's take a look at the S&P 500 SPY ETF. So let's crack open this chart and see what's going on in the stock market today. Very quickly, don't forget to take advantage of my 50% off 1 month of bank trade alerts and the Stocks Channel Trading Discord community with the Memorial Day sale that you can find out how to claim by clicking on the links in the description of this video. Alright, today SPY was up 0.04%, so it went absolutely nowhere. And in the morning, we did gap up outside the upper Bollinger Band, and we did fully close the gap at 421. If you watched my weekend update, I said it was all but a guarantee that we were closing that weekly gap on the XPX, and that is exactly what we did today. Now keep in mind, we still have one more gap above on SPY at 425.5, and with the bull trend, there's a very good chance we are going up there to close that gap. So that begs the question of whether or not we are going to start seeing participation from some of the other sectors like the financials, industrials, and healthcare sector. This whole rally is still built upon the back of the big tech companies, and today was no different, with the majority of stocks that were advancing being in the tech sector and the majority of the stocks that were declining being in all of the other sectors mentioned. So that is not a healthy bull market. Even though we do have a bull trend in the S&P 500, it does not have what it takes to be a healthy bull trend unless we start seeing that participation from the other sectors. So with that being said, we have to follow the chart, and this is still bullish price action, which means we could still be trending higher because we have the bull trend in the price action above all the moving averages. But you need to manage your risk right here at 417. And if we start to break down below it, you need to start managing risk very closely. I'm just giving you a warning because we do have a lot of weakness in those other sectors. And if we start to see weakness in the tech sector, SPY is going to start dropping very quickly. And that's why I always use that saying, the bears take the elevator down. So just watch that support very closely. And while price action is above that support, you can stay bullish. But if we break below that support, you instantly need to get a lot more risk off because things can start picking up very quickly to the downside. Typically speaking, the month of June is very volatile to begin with, and that doesn't guarantee we have to go lower. So don't just be one of those people that say sell in May and go away without following the chart. We always follow price action and trend, and right now those are still bullish. But there are some reasons to be cautious and just be aware of what could be coming. So on SPY, we'll stay bullish while we're above 417 with a good chance we go higher towards the gap fill at 425.5 and the August highs at 430. If we start breaking below support at 417, we're looking for downside critical support levels at 414 and right around 410 to 411. On the NASDAQ 100 triple Qs, we were up 0.45% today, and the triple Qs are extremely overextended, opening outside the upper Bollinger Band yet again, and we are now in the bear cave between the zone of 350 to 360. Remember, this is the big bear, and this bear is not one of those bears that calls for a crash each and every day. This bear has a plan, and this bear knows exactly what he's doing at these levels. For that reason, I think there's a very slim chance the triple Qs climb too much higher than above 350. But if we do go above 350, we're looking for critical resistance at 360. So watch this zone very closely, and I think there's a very good chance we're going lower before we go any higher in the triple Qs. But obviously, this is a very bullish chart. I'm simply being cautious because we're at critical resistance and we're looking a little too far overextended. Also pay attention, we did see an increase in volume today, and a lot of that was selling volume because we did gap up higher and we closed lower than the open. So just be very cautious and heed my warning that you don't want to be getting overly bullish at these critical resistance levels. If we start to sell off, we're likely coming all the way back down towards 337 in the gap fill at 333. So that could be a very significant drop, and it could take only a few days to get there. If you want to stay bullish above here, I would instantly get a lot more risk off if we start closing down below 348, because that's likely going to pick up the selling pressure down to the low 330s. On the Dow Jones, we were down 0.1% today, and in the Dow Jones, you can see exactly what I'm talking about with the weakness in the other sectors, because we do have a bear trend in the Dow Jones and we're sitting right near the 200 daily moving average. You can stay bullish in the Dow above 327, but if we break below it, we're likely going down to the gap fill at 322. Critical upside resistance will be 333 and 336. And if we break 336, we're instantly getting a lot more bullish because it's going to look like we're breaking out of this bull flag and going towards 346. On the Russell 2000 IWM ETF, we were down 0.37% today. And intraday, we did close the gap above 177, so we can delete that gap. But as you can tell, we were met with resistance instantly at the gap fill, and we did close down below critical resistance at 176 yet again. So this is what I continue to warn you about, is that a lot of these other indices and sectors are seeing a lot of weakness, and a lot of the strength is simply coming from big tech companies. So to get more bullish in the small caps, we need to break above 176, and then we will be looking for the gap fill at 181. And then above 181, we'll likely have a bull trend and we can start going to higher prices. However, we need price action to prove it, and right now price action is weak, with a trading range between 174 and 177. Below 174, look for the gap fill at 171 and the critical support at 170. If we break 170, we have a confirmed head and shoulders, which is obviously very bearish and means we're likely going down to 52-week lows. On the ARKK ETF, we are up 1.82% today, coming back up into critical resistance at 40.5, and this is exactly where we've been seeing high volume rejections for all year long. We need to break above 41.5 before I say the ARKK ETF is bullish, and I simply don't think it's worth the risk to guess. Wait for the confirmation in the price action. A high volume rejection from here could bring us back down to the gap fills at 36 and down below 32. On the VIX, we were up 0.11%, and the VIX really went nowhere today, even though it did try to spike above 18 at some point in the day, but it continues to get crushed. To get more bearish, we need to see the VIX above 20, and it's as simple as that. On Bitcoin, we're currently down about 0.25%, and Bitcoin is getting rejected from this resistance around 28,000 because it was also outside the upper Bollinger Band. You can see based on the resistance trend line, we are still making lower highs and lower lows, and we're at critical support as we approach 27,000. Below 27,000, I'm looking for the price target at 24,000 and possibly even a test of the rising 200 daily moving average. We're not getting bullish until we can break out to a higher high. On Tesla stock, we were up 4.14% today, and Tesla did exactly what we were expecting, which was a test of that negatively sloping 200 daily moving average. So this is exactly where we are going to see the critical test in Tesla stock, because if we can start closing above 200 and then break this high at 208, I think we are going into a bull trend. However, we need price action to confirm it by getting another close above 200, turning 197 into support, and then breaking the resistance at 208. Above 208, we're looking for the price target all the way up there at 230 and possibly even 260. Even though on the way there, we will have resistance at 214. If at any point price action breaks below support at 197, this is a false breakout and a bull trap, and we're likely coming back down towards 183 and then 173. So watch those critical support levels up here between 200 and 197 and manage risk very tightly at that level if you're bullish. On Apple stock, we were up 1.07% today, and intraday we did break out above the price target at 177, and we did tap the price target at 179. If we can break 179, that means we're testing all-time highs up there at 182, and if we don't break through this resistance, there's a good chance we get rejected and come down to fill the gap below 176 and test support at the breakout at 174. Critical support levels for Apple to maintain the bull trend are 174 and 170. And if we break 170, it looks like we're going through a correction that could take us back down to the gap fill at 167 and possibly even all the way back down to the gap fill at 158.5. However, we need price action to break that critical support before we say it's happening, so let the price action do all the talking. On the financials, we were down 0.03%, and we still have the bear trend while we're trading below 33, and we have gaps to fill at 32.26. And we have a gap to fill at 33.04. There's a good chance with the bear trend we're coming down to fill the gap at 31, so just a risk off while we're trading below 33. On the industrials, we were down 0.15%, and I'm viewing the industrials as bearish as soon as we break down below 97 in a trading range until we do so. Below 97 is bearish, and we're not getting bullish until we can start closing above 101. On the healthcare sector, we were down 0.62%, and we are getting extremely oversold in the healthcare stocks, and we are in a bear trend as long as we're trading below the negatively sloping 200 daily moving average at 131. However, because we're getting very oversold, I do think we could bounce back up towards 130, and then if we get rejected and form a lower high and confirm the bear trend, we will be looking for lower prices. On the energy sector, we were down 1.03% as we continue into the bear trend with the price target below at the gap fill at 73. We're not getting bullish until we can start closing back over 81. So jumping back over the S&P 500, without a doubt we have a bull trend in SPY, but there is not a lot of reasons to be overly excited until we start to see participation from some of the other sectors. The S&P 500 is going nowhere without the financials, and the big tech sector can't carry the weight forever. It's great to see the tech sector leading the way higher, but now it's time to start getting participation from the other sectors to confirm the bull trend, Otherwise, this is an unhealthy bull trend, which means we could see high volume selling. So don't panic, just have a plan, and I gave you all of the critical support levels. If price action breaks below those critical support levels, you instantly need to get risk off. It's that simple. Do not overcomplicate it, and keep emotions in check by letting the chart do all of the talking, and then just strictly follow your trade plan. Don't forget to take advantage of my Memorial Day sale, where you can still get 50% off bank trade alerts and the Stocks Channel Trading Discord community. You can find out all of those details about claiming your discount by clicking on the links in the description of this video, as well as the comment section. So thank you for watching, everybody. I hope you're crushing this market. And as always, I will see you in the next episode.